Hi friends, welcome to Vantage Points 3. In today's session, I'm going to talk about corporate bonds and how do you value a corporate bond and what are the intricacies involved in that. And of course, the attraction of corporate bond in a rising inflation scenario also. So let's get started with a few basics on this in this aspect. So as we all know, debt instruments are used typically by corporates to raise funds from the capital market. Of course, there are no voting powers or dividends, but you receive regular interest called interest income, and then you have a redemption value, either a capital gain or a capital loss at the time of transfer or redemption. Now, there are broadly two types of these corporate bonds which are issued by corporates. Of course, there are a lot of variants, but suffice to remember that you have coupon bonds or zero coupon bonds. So, in coupon bonds, you get there's something called a coupon, which is nothing but a regular interest rate. So, you keep receiving the interest at every year or at regular intervals, and then you get the principal at the maturity. Uh, you know, then if the bonds are listed on stock exchange, these bonds are also quoted from time to time based on the rise in interest rates and things like that. So the market value of a bond that is being quoted on exchanges and all is nothing but the present value of all future cash flows. So, when we say present value of future cash flows, a simple example is if you buy something at 100 today, and because of inflationary trends, the same item is available at 110 next year. Essentially, the 110 next year is brought to the present value of 100 because of the rise in inflation by 10%. So, 110 divided by 1.1 is 100. So, that is how, if you are getting cash flows over a period of say 5, 7, 10 years, sum of regular interest incomes and redemption value at the end of year 10, we need to discount it to the present value. That is called the value of the bond or the price of the bond. Okay, so the rate at which we discount it is nothing but your internal rate of return. Essentially, so that is the return you get, and that is reflected in the price. That's determined by the market, and the bond prices keep varying from time to time. Uh, Okay, in the zero coupon bonds, there is no coupon there. So the bond is issued at a discount to the face value. Say 100 rupees bond is issued at say 80 rupees, and on redemption you get 100. So over a 3-year period, let's say. So the implied return is this 20 rupees over a 3-year period kind of thing. So that's how the two sets of bonds are issued by corporates. There are a lot of variants which we don't have to bother at this stage. Uh, so the difference in a zero coupon bond, the difference between the redemption value and the issue price is treated as a capital gain. So that's the primary difference. So in terms of long-term capital gains, so if the bonds are listed on stock exchange, for example, HDFC issues a 10-year bond and it's quoting at X price, so they're all listed bond prices and bonds get traded. So if you hold such a bond for more than 1 year, you are entitled for long-term capital gains. And it's important to remember that the long-term capital gains are currently taxed at 20% without indexation. That's the primary difference. Even though they are all capital assets, but the treatment of bonds is different from treatment of other capital assets. The treatment of stocks is different from say capital assets such as house property. So there's some kind of an anomaly in the short term and long term capital gains in India. So the government is trying to rationalize these probably in the months and years to come. So if you hold a bond for less than 1 year, then it's a short-term capital gain. So that's taxed as per your personal income tax bracket. So that's basic things to remember. Now let's quickly go to, there is some variant called capital index bonds or sovereign gold bonds issued by government or RBI respectively. So there the indexation benefit is available, and on top of that you pay 20% as the capital gains, which means you save 10 because of indexation. The cost of purchasing the bond will go up, hence your capital gains will come down, so your tax liability will also come down. Or you have an option of paying 10% without indexation, so that's an exemption more than a rule. Now let's quickly move to how does this bond price, how do you value bonds? Very important concepts are available. Suffice to know that there are two types of risk when you buy a bond. One is a default risk So the company is credit rated, AAA, AA rated and all. There is some backup in terms of mortgage-backed securities and all are given. So all your whatever bonds you buy are backed up by some kind of a security and all. So credit rating agencies typically give a certain rating, but still you have a default risk that the likelihood of a company not paying you the principal is a possibility. Similarly, there is an interest rate risk which is coming from the market forces. So you have a business risk and a market risk. Market forces essentially they stem from RBI's monetary policy. So if they keep raising the interest rate, then it has a significant impact on the bonds and bond prices that are getting quoted. So let's see how that works. Okay, there's something called a yield to maturity from bonds. Like I said, if you put 100 rupees and second year it becomes 130, first year it becomes 130, second year it becomes 200. On average, your compounded return is about 41%, like that. Or if it becomes 200 in 3 years, your compounded average is a little lesser. So in term yield to maturity is nothing but the rate of return, average rate of return you get by holding the bond for the duration for which you hold the bond. You don't have to bother more than that. For a good example, for example, HDFC is giving a 9.75% coupon, say 2017 bond, right? That means it is expiring in 2017. Issued on 19 July 2007, 10 years back. It's a long-term bond. It has issued a bond on 19 July 2007 and it is maturing on 19 July 2017 with annual stream of 9.75% for the people who hold it throughout the period. There is no issue there. No interest rate risk and all. You get your bonds regularly, interest income regularly, and then you redeem it at the face value. And then but there is a bond, this bond is quoting it say 104 rupees on 1st November 2014. Somewhere in between you decide to buy. That means your cash outflow here on 1st November is 104 rupees, right? And because it pays you interest of 9.75% every year, you get on 19 July 2015 you get 9.75, 19 July 2016 you get 9.75, and 19 July 2017, which is the expiry date, you get this 100 plus 9.75, which is 109.75. Now, because there are different cash flows, you are inflows and outflows and different periods, how do you know the return? So this formula or this calculation everybody should know, even retail investors. Is extremely useful tool, something called XIRR. This IRR is nothing but internal rate of return, is nothing but this returns you get per annum or a period of time with different cash flows kind of a thing. So if you use that, it comes to about 9.18%. Now just to cross check, how do we see that it is 9.8%? So on 1st November your outflows are 104. Then you have 9.75, 9.75, 9.75 for 3 years and 100 rupees at the end of 3 years. You have different time periods. So 1st November to 2014 to 19 July 2015 is 0.71 years. Then the 19 July 2016 is 1.72 years from the 1st November date. Okay. And expiry date, that if you calculate the time period, the duration for which you hold the bond, rather not the duration but the time period, is 2.72. So if you discount these cash flows at the same 9.18% per annum, then you get 104. So that's how the the mathematics work behind that. But you don't have to know more than that. But at a basic level, of course, finance guys know a lot more than this. Essentially, this is for only non-finance people. Okay, so rise in inflation leads to rise in interest rates, which in turn will lead to fall in bond prices. So bond prices and interest rates have inverse relationship. Okay, so in a rising inflation scenario, you must park your funds in liquid or short-term bonds to begin with to protect your capital. Otherwise, your bond prices will eat into fall in bond prices will eat into your capital and it will lead to a capital loss because RBI comes and raises the interest rate subsequently. So the attractiveness of the current bonds you are holding will fall. So that's the sum and substance of what we are trying to say. Okay. Very important to note these tables. These are the cost inflation index tables released by Income Tax Department from time to time every year. So all the capital gains we pay are based on these tables and the numbers given below. For example, in 2001 and 2, the base year, the cost inflation is set to 100. And from there onwards, if you look at the inflation in terms of cost inflation index, it's 5%, 3.8, 3.6, 3.5. So it actually bottomed out in 2005-6, and then it started going up again. So this is how the interest rates move up and down. Okay, and then it peaked out somewhere in 2010-11 at around 12.838%. So what it means is, right now we are in a rising inflation scenario. So it's important to know what has been the historical interest rates in a rising inflation scenario in our own country. So I've tried to present a 20-year record, as determined by the income tax authorities. So we have bottomed out in 2018-19. The cost inflation index, as per that, the inflation is 2.941%. Okay, and then now slowly it is started going up, and today 2021-22 it's given a 5.316%. Okay, now probably next year it will be higher as we have started experiencing higher inflation. Now, these are the tables which will be used to calculate the capital gains. Now, I'm slightly moving away from the bond, because in bonds you don't have the indexed to inflation advantage. So, in my next session, I'll be talking about house property and how to save taxes on sale of house property. But because it's linked to indexation, it's linked to inflation, so I thought it's prudent to bring in the cost inflation index tables also into our discussion point. So apart from, in general, long-term capital gains holding period is 3 years. For any capital asset, right? And if you transfer or sell after 3-year period, you are charged at 20% with a 3% surcharge with indexation benefit. So let me explain the concept of indexation a little bit for non-finance guys essentially. So if you have bought a flat in 2001-2002, where the base year is set to 100 as per the table at 25 lakhs, and sold it in 2021-22 at 150 lakhs, so it appears that you have got 125 lakhs gain. That's not true, because the cost of acquisition of the flat shall be indexed to about 79.25 lakhs now, because your current index is 317, you bought it at 100, so 3.17 times the increase in original cost is treated as cost of acquisition of the house. So therefore you have a capital gains of around 70.75 lakhs, which is nothing but 150 minus 79.25 lakhs, right? Now you have to pay tax on this. So that's the long-term capital gains at 20% plus 3% surcharge. That's about a total of 14.5745. So that's the basics of cost inflation index. It gives you an insight into what has been the high rates of inflation in the last 20 years in our country. So can it go again to 12.8? You'll never know. We can't predict how the inflation goes up and to what extent it goes and stops. So two things. First, be careful to park your funds in short-term liquid funds when it is bond funds. Now, I want to end this by giving you a very useful tip on, what is the point of time, how do you get advantage of this cost inflation index tables. Okay. So that if you see, for example, if you are if you're selling a flat, say in Jan, February, December, it's prudent to postpone if possible to sell the property in April. So instead of selling it in March, if you sell it in April, you get one full year of indexation benefit, because your sale happened in March. So in April, income tax guys will come up with their new indexation number. So you have to pay the capital gains in that year itself. Whereas if you sell it in April, you get you have to pay the tax only next year. So you get the full 1 year benefit, and if that indexation gives you 7-8% additional benefit, so take it. So that's how you should look at it. So sometimes usually investors miss out on these things. So it's a marginal case. Try to shift it and get the benefit of one more year. So these are some of the insights I wanted to share. In the next session, I will share in detail about the loss on house property, or the how to save taxes on capital gains arising out of sale of house property. There are lots of stuff, so I'll be very happy to share those things. Thank you for listening me out on this. As always, I'm not a tax expert for sure, so please consult your tax advisor. Of course, this is only an educational video, so all the standard risk disclaimers apply. Do your own due diligence at your end. Thank you very much. I'll see you on the other side in the next session. Thank you so much.